Welcome to the Deep Dive. Today we're taking a closer look at something pretty fundamental for anyone who trusts financial statements.
That's right. We're talking about International Standard on Auditing 560, ISA 560.
Exactly, IAASB 560. Now, I know audit standards might sound a bit dry, maybe, but honestly, understanding this one, it gives you this real inside look at how auditors handle things that happen after the company's year is officially ended.
It really does. It's all about making sure those financial statements you see are as reliable and, well, up to date as possible, considering what might have occurred later.
And it's not just for auditors, right?
Yeah.
Anyone relying on those financials, investors, banks, even employees, gets a glimpse into the rigor behind the numbers.
Absolutely. It's about understanding the concept of subsequent events. These are things that happen after the snapshot date of the balance sheet.
Okay, so let's maybe structure this. The standard itself has a pretty logical flow, doesn't it? Introduction, objectives.
Yeah, definitions, which are crucial here, then the actual requirements, what auditors have to do, and then extra guidance, the application material.
Great. So let's start with the basics. What exactly are subsequent events in the eyes of ISA 560? And what's this timeline we keep mentioning?
Okay, so the standard defines subsequent events in two distinct periods, really.
2 periods.
Yeah. First, you've got events happening between the date of the financial statements, that's your year end, say December 31st, and the date the auditor actually signs their report.
Okay, so the period while the audit is being wrapped up.
Exactly. And second, it also covers facts that the auditor finds out after they've already dated their report. So two distinct chunks of time to consider.
Got it. And you mentioned key dates there. Let's just clarify those quickly. Date of the financial statements.
That's the end of the period being reported on, like December 31st for a calendar year company.
Right. Then the date of the auditor's report.
That's the day we, as auditors, finish our work, gather enough evidence, and formally date our opinion. It signifies the end of our evidence gathering, essentially.
Okay. And finally, the date the financial statements are issued.
That's when they're actually released, made available to shareholders, the public, whoever needs to see them.
This timeline seems absolutely critical to understanding the auditor's responsibilities here. It's not just about the year itself.
Not at all. Our duties change depending on which phase of this timeline we're in.
So let's talk about that first period, between the financial statement date, the year end, and the date the auditor signs off on the report. What's the auditor doing then?
Well, in this period, we have an active responsibility. We need to perform specific audit procedures.
Active meaning you're required to go looking.
Yes, actively looking. The goal is to get what the standard calls sufficient appropriate audit evidence about any events in that window that might need the financial statements to be adjusted, or at least disclosed in the notes.
Sufficient appropriate evidence, meaning enough good quality proof.
Pretty much, yeah. Enough evidence and the right kind of evidence to support whether something needs adjustment or disclosure because of that subsequent event.
So you're not re-auditing the whole year, but you are doing specific checks related to this period.
Exactly. It's focused.
Okay, so what kind of procedures are we talking about? What does that look like on the ground?
Well, first, we need to understand management's own process. How do they identify subsequent events? Because they're running the business day to day.
Right, they should know what's going on.
Hopefully. So we inquire about their procedures. Then, crucially, we make specific inquiries of management and, importantly, also those charged with governance.
Those charged with governance, usually the board or the audit committee.
Yes, exactly. People with oversight responsibility. We ask them directly if they know of any subsequent events that might need reflecting in the financials.
Makes sense. What else?
We read the minutes. Minutes of meetings of shareholders, management, the board, any relevant committees held after the financial statement date.
Because big decisions or discussions might be recorded there.
Precisely. Things like major acquisitions agreed in January, or maybe the settlement of a lawsuit, stuff like that. We also look at the company's latest interim financial statements, if they produce them.
Like quarterly results.
Yeah. Comparing those to the year-end figures might flag something significant that's happened since. So it's a combination of asking, reading, and analyzing.
So you're proactively hunting for things. Can you give a quick example just to make it concrete?
Sure. Imagine a company has a December 31st year-end. In mid-January, before we sign our report, their main factory burns down.
Oh, wow.
That's a major event, right? It doesn't change the December 31st financial position directly, but it hugely impacts the company going forward. It would almost certainly need disclosure in the notes to the financial statements.
Got it. So even if the numbers themselves don't change, the context does, and users need to know.
Exactly. Or Another example, if a major customer went bankrupt in January, that might mean the receivables owed by them at December 31st are now uncollectible. That could require an adjustment to the year-end numbers.
Right, that makes it very clear. Okay, so that covers the period up to the auditor signing the report. What about the next window? After the report is signed, but before the financial statements are actually issued to the public.
Okay, this is where the responsibility shifts a bit. The standard is clear. The auditor has no obligation to perform any further audit procedures after we've dated our report.
So, pins down, job done.
In terms of actively looking,
Yeah.
yes, our field work is complete. However, and this is a big however.
I sensed a however coming.
Yes. If, during that specific window after report date, before issuance of fact becomes known to us, something important.
Becomes a no, so you might stumble across it, or someone tells you.
Exactly. We're not obligated to search, but if something comes to our attention that, had we known it before we dated our report, might have caused us to change that report,
Yeah.
then we do have a responsibility again.
No.
Okay. So a significant new piece of information surfaces. What happens then?
First step, always, is talk to management. Discuss the matter, understand it fully.
And figure out if the financial statements actually need to be changed.
Yes. We need to determine if amendment is necessary, and then ask management how they intend to address it.
Okay. And let's say management agrees. Yep, this is significant. We need to amend the statements. What's the auditor's role then?
If they amend, then we have to essentially reopen our work slightly. We need to perform the necessary audit procedures on that specific amendment.
Check their work on the change.
Right. We need to be satisfied with the amendment. And then we issue a new or amended auditor's report. Importantly, this new report would be dated later, no earlier than the date the amended financial statements are approved.
Okay, so the timeline gets updated to reflect the new information.
Correct.
But what if management doesn't agree? The auditor thinks an amendment is needed, but management says no.
Yeah, that's the tricky scenario. If we believe an amendment is necessary and management refuses, we have to take action.
Such as.
We must notify management and also tell those charged with governance, the board again, that we believe the statements need amending and management won't do it. And crucially, we need to state that we will take steps to prevent reliance on our original auditor's report.
Prevent reliance.
How?
Can you just withdraw the report?
It depends on the legal and regulatory environment, but options could include informing regulatory bodies, seeking legal advice, or taking steps to ensure anyone receiving the financial statements also receives notice that the auditor's report should not be relied upon. It's a serious step.
Definitely sounds like it. You're basically warning people off the report you just issued.
It underscores our responsibility isn't just to the company, but to the users of the financial statement.
Okay, that's a critical phase.
Yeah.
Now, the final scenario. What if the financial statements are already out there? They've been issued, and then a significant fact comes to light.
Right. So post-issuance. Again, the starting point is the auditor has no obligation to perform any audit procedures after the statements are issued.
So definitely pens down now.
Pretty much. But similar to the last phase, there's that exception. If a fact becomes known to us after issuance, which, if we'd known it back at the date of our report, might have caused us to amend that report.
Then the responsibility kicks back in.
Correct. The trigger is the same. A significant fact that could have changed our original opinion or report content.
And the process. Still talk to management first.
Always. Discuss the matter. Determine if the financial statements need revision this time, not just amendment, but actual revision since they're already issued, and inquire how management plans to deal with it.
Revision, meaning potentially recalling the old statements and issuing new ones.
Yes, or taking other steps to inform users that the previous statements are superseded or need to be read in conjunction with new information.
And if management agrees to revise.
Then we, as auditors, have responsibilities again. We need to review the steps management takes to ensure anyone who received the original statements is informed. We audit the revision itself.
And issue a new report again.
Yes, we'd issue a new or amended auditor's report, but this time it would typically include specific paragraphs, an emphasis of matter or other matter paragraph.
What do those do?
They essentially flag it for the reader. They draw attention to the revision, explain why the statements were revised, and refer to the detailed notes management provides about the revision. It ensures transparency.
Okay. And the nightmare scenario again. What if management refuses to revise the statements, even after they've been issued, when the auditor thinks they should?
This is arguably even more serious because the potentially misleading information is already public.
Right?
We must notify management and those charged with governance of the refusal. And then we have to take appropriate action ourselves to try and prevent future reliance on our original audit report.
Like what public statement? Informing regulators.
Again, the specific actions depend heavily on the legal context and professional rules. It could involve discussions with legal counsel, notifying regulatory authorities, or even notifying the public directly in some jurisdictions, potentially. The goal is to sever the link between our potentially unreliable original report and the unrevised financial statements.
Wow. So the auditor's duty can extend quite far beyond just signing the report initially.
It really can, especially when significant issues come up later.
So just to bring it back together then, the objectives of ISA 560, what's the core aim?
There are two main objectives stated in the standard. First, to get enough good evidence about those events happening between the year end and the report date that need adjustment or disclosure.
The active-looking phase.
Exactly. And the second objective is to respond appropriately if facts come up after the report date that, if known earlier, could have changed the report.
The reactive phase, covering both before and after issuance.
Precisely. It's about ensuring the final package statements and report is as reliable as possible given events unfolding over that whole timeline.
And this standard, ISA 560, it lays out how auditors worldwide should handle this, right? Been around since audits for periods starting late 2009.
That's correct. It provides that consistent framework we talked about. It helps explain, why sometimes you see companies issue revised financials or why auditors' reports might contain those specific paragraphs mentioning later events. It's often ISA 560 in action.
It really shows that financial reporting isn't static. It's dynamic, even after the snapshot date.
Absolutely.
Okay, so to quickly recap for everyone listening, we've kind of walked through the different time periods concerning subsequent events. The crucial window between year-end and the auditors signing off, where auditors are actively looking.
Performing procedures.
Then the period after signing, but before the statements go public, where the duty is reactive if something big comes up.
Right. React if needed.
And finally, even after the statements are issued, there's still a potential responsibility if a truly significant fact emerges later.
Yeah, it covers the whole life cycle, really.
It definitely gives a clearer picture of the diligence involved. It's not just ticking boxes on December 31st.
Not at all. It's about ensuring ongoing relevance and reliability.
Well, hopefully this deep dive has shed some light on ISA 560 and why it matters for the credibility of financial information.
We hope so. It's a vital part of the audit process.
So maybe a final thought to leave our listeners with. ISA 560 really tries to balance two things, doesn't it? The need for timely financial reports versus the need to incorporate significant later events. What do you think are the biggest inherent challenges in actually achieving that balance in practice? Something to mull over. Thanks for joining us on this deep dive.